Good day, everyone. Welcome to JK Michael's Knowledge Series. Today, we're going to take a closer look at investment options. All the while, we've talked about the psychology of investing, which is understanding that you need to save and invest rather than spend everything. Understanding that the first thing that you need is the ability to earn, right? So when you can earn, then you can save and invest. We also said that if your earning is not strong enough, then what you should do initially is to focus on building earning capacity or your ability to earn. Then after that, investments and saving can come after that, right? So we're going to be talking about how we can invest, right? And what parts and what choices exist. But this is the overview. And we'll go into more details as we proceed. Let's begin on this subject. Now, a very important goal will be to help you to understand what your investment goals can be, understanding risk and return, asset allocation, which is teaching us not to keep all our eggs in one basket, right? This is, of course, risk management and how we can be able to distinguish the best investment firms from the rest. And I think we'll cover that in a later video. Now, let's talk about goals. Well, in investing, you need to be very clear on your goals. In the same way, you need to be clear on your life stage. So let me begin with the life stage aspect. If you're a very young person, you have time to burn, you can afford to take risk, and you have some quite good earning capacity, then you might want to consider higher risk investments. When I say higher risk, I'm talking about things like stock. I would not necessarily call forex trading an investment in a broad general form of putting your money in and getting something out over a period of time. Or you could call that an investment, but stock trading, forex trading, and I would rather call it trading, but in a general sense, one could consider that an investment, cryptocurrency. Now, these are and can be very risky. Um, so yes, you can attempt that with stock being what I consider the best balance of risk against long-term return. I mean, just my consideration. I also know people that have built wealth and significant fortune with crypto. That's a young man's game. Moment you begin to cross into your 50s, when you're accumulating money, you're focusing more on capital preservation rather than capital appreciation, right? You are getting towards retirement. Your investment, your earning timeline is not so much again. Your capacity for taking risk that probably can wipe you out is not so much again. You want to then focus on lower risk investments that would protect your capital, right? So you want to define what you are saving for. Now, there's a psychological side of knowing what you want, right? For instance, you don't want to be building a lot of wealth. Why? Destroying from your family or taking away from your health. And I covered that in an earlier video. You need to define why you are saving and what the money will be used for. Am I saving for my retirement? So let's put it out clear. Am I saving for my retirement? Am I saving to buy a car? Am I investing for um long term? Just long term. So for instance, for me, I do a 10, 20-year stock investment plan and strategy. And I have stock that I intend to, I mean, without any major change, I intend to hold over the long term. And I know that this is just to accumulate my asset pot over 10, 20 years. So it's very important that you should know your financial objectives and then let the intended use determine the investment duration. So, for instance, in climbs, and I've spoken about this earlier, in climbs where you pay a rent annually, then you want to put out money for annual purpose. You don't take that money and put in the stock exchange because the stock exchanges, the stock market has a high risk and high variation in a short term, like 6 months to 1 year. And then it has a surer bet of giving you fantastic returns in the longer term. So yes, your time frame, what you want to do, which is maybe save for a car, save for a house, or pay your house rent in 1 year, should determine how long your investment window should be, or at least for that investment. And then you want to match investment choice to purpose and time horizon, which is what we are saying. Why do I want this? I want to rent a house, but that's why I'm saving. I want to purchase a car or a new asset. That's why I'm investing. I'm saving. Then okay, it should help you to be able to select what kind of investment option to use. It will also help you with, of course, with the time horizon. Now, time horizon, how long will the money remain invested? You want to do it 3 months to shut out. You have some free cash and you want to hold it in a place that it will generate some kind of return over a very short term. They choose some kind of saving plan or money markets, hold it in money markets, and then just very short-term financial instruments that can deliver some returns for you annually. Short-term funds need capital preservation. Like I said, you don't take your house rent and put it on the stock exchange. There's a chance that it can move 50% less than that in a period of a month. So you don't use short-term funds for capital appreciation. I mean, significant capital appreciation investment. And long-term funds would allow compounding. And if you lose, then over a period of time, it will smoothen out and you're likely to recover from whatever loss you take. Now, let's look at in a basic, extremely fundamental level, let's look at risk management strategy. So we have risk tolerance. And then the goal of risk tolerance, what's risk tolerance? How much risk you're willing to take at a period of time, right? And risk tolerance can be high at a level, right? So like I said, when you're younger, you're likely going to have more risk tolerance than when you are lower. It could also change depending on the various phases that one's may be at life. So I'm a risk seeker. It doesn't necessarily mean I'm going to be a risk seeker throughout my life, right? Okay. Now, it's very important to align risk level with time frame. You want to do things like align risk with your own personal comfort. Don't take risks that you are uncomfortable with. Any risk that makes you feel like, oh, this is too much for me, I'm going to lose significant value, do not take it. You want to avoid high risk for near-term spending needs, which is what I said. Don't take the money for your house rent, your utilities, or an annual payment you're supposed to make and put it in the stock exchange. It is too risky, right? And then accept volatility for long-term objectives. So yeah, do your little analysis or do your analysis on long-term investment. And when you put it into long-term investment like stock, then understand that it will go up and it will go down. And that's the way of stocks, right? To go up and it will go down. But in the long run, generally you will see an upward trend. So that should encourage you to put your money in the stock. Just make your bets, do your analysis, and determine the best stocks to hold and manage your money or to invest your money in, and then stay there, right? And that would do more value than tinkering with it all around. Okay, so let's look at the next thing. So So let's go over it again. You want to choose conservative investments for short horizon. Now, when you are going for long-term investment or long-term horizon, 10, 20 years, choose growth-oriented investments. Now, it's very important to note that um, there are different kinds of stock. For instance, there are stock that give you a lot of dividends called income dividend stock. And there are growth stock which ideally should not even give you dividends in the initial years when you put in your money, right? What we expected is that the investment would compound and would compound and would compound on the stock exchange. And because of the growth of the company or the growth of the industry, it will be expected that whatever monies that come in the form of earnings will be replowed as retained earnings to be able to accelerate the growth rate of the organization or of the company, right? That would work excellently well for the long term, but of course it will not work for the short term. You want to make sure that time on the stock exchange is almost always, if not always, your friend, right? Irrespective of how things go down and how things go up, time will generally smoothen out your risk. So use time in long-term investments to absorb market fluctuation, and you want to be consistent, right? Know your goal, know your investment horizon, and stay consistent with it. Now let's go into the primary investments. Now, there's a lot you're going to hear over time. You're going to hear about money market, you're going to hear about bonds, you can hear about stocks, you're going to hear about a lot of investment vehicle. What is important is this: there are only two types of investment vehicles, and we call them the primary investments, right? There's a lot of different organizations who call their products different labels and different names. And of course, banks are known for creating this investment, banks and investment houses are known for creating these investment tools, giving them really interesting names and selling them out. Just know that there are only two types. You are either lending or you are owning. And we know what lending is. I take my money and then I give it to someone. I don't care what you use my money for, just as long as, I mean, generally, you don't care what the person uses your money for, just as long as the person finishes. It gives you your money gives you back your money at the nominated interest. And that's lending. Ownership, however, is that you own that business, right? So you buy a piece of the business, and that happens with so lending can easily be seen as a very good example of lending as an instrument will be bonds. Bonds being the most classic lending instrument, and then we have ownership with stocks being the most classic ownership investment instrument. Now, let's look at lending investments. Like I said, you as an investor are a creditor to the institution. So let me say, I purchased the bonds of a particular organization, then I'm lending to them. I'm going to be earning a fixed interest income. So they're promising me something like a 5%, 10%, 12%, and it's going to be fixed over the duration the of the loan, because it's a loan, right? Now the principal, like I said, is going to be paid back at the maturity date. So the loan is going to be agreed over a period of 1 year, 4 years, 5 years, and then I'm going to be paying you back with an agreed interest rate. The maximum return is limited to the agreed interest plus principal, right? So you can't earn greater than the agreed interest and the principal being put back in, right? Now, again, these are pretty safe investment vehicles. The risk of default will reduce the risk of default, sorry, can reduce or eliminate returns. Sorry, that wasn't what I wanted to say. Um, if the client or if the borrower defaults, then your returns are eliminated, right? But generally, in standard management and finance practice, lenders are taken care of before investors. So no matter what the risk of default is, the guy that owns the company still has greater risk. But the problem with this vehicle is that inflation is likely to erode the real power, right? So if you have a return, you promise a return of 7%, inflation is at 5%, then your real return is just 2%, right? So inflation will reduce what real purchasing power of returns. In this case, you're just chasing for tools that will offer returns that will beat the inflation rate. Market value also can fall when interest rate rises or the quality of the issuer declines, right? Now, and uh, uh, that's another issue, right? The market value when interest rate rises can, of course, decline, or the issuer quality, right, declines. Then the market value that, and this will be for things like bonds, right? Concentrating in fixed return investment can limit real diversification. Another downside, you put too much money into your fixed returns, then you don't have diversified growth. Diversification should allow you to be able to um, appreciate interest, appreciate your assets, right? And still preserve, right? It should be able to spread your investment across investment classes. So you have a couple of the safe ones where the ratio would depend on you, where you are, and your risk appetite. But you want to have you want to invest in various asset class, real estate, stocks and bonds and real estate, stocks and bonds and whatever other vehicle, right? Now, concentrating in fixed income on the other hand, or fixed return will limit real diversification. And then investors do not participate in the growth of the issuing entity. Um, I I lent you money does not give me the authority to ask you how do you spend the money or what do you do? This is how you should grow my money. No, I'm not an owner. I just lent the money, and I think we should be fine about that. And that's the whole idea of this. Now, moving on, let's look at ownership investment. Investor holds equity in income producing assets, right? So I buy ownership of a particular slice of the company, right? And it's going to produce, as long as the company is producing income and doing well, then I continue to earn. And that looks really, really great. The problem with this is risk, though. Returns will come from profits, right? So when the company earns, then I get some kind of return which will be given back to me in the form of dividends. And then also when if the company is quoted on the stock exchange, it continues to appreciate. Then I earn some more pending when I sell. So value rises with business performance and earning growth. As long as the company is improving its growth and its earnings, then of course, then my returns will continue to rise. On the other hand, if economic conditions, environmental economic conditions, or the quality of the firm's operations should decline, then value will fall. Returns are not capped. When you put your money into the stock exchange, for instance, nobody tells you that it's going to be 15%, it's going to be 20%. If the firm can double, triple, quadruple, multiply by 5 your investment in 1 year, what that means is also your your capital can greatly also depreciate in 1 year. So there's nothing capping it at the top. There's nothing stopping it from falling below the barest minimum. And performance depends on operations and economic conditions, so how well the company is operating within the period, and then are we in a recessionary period? Are we in an expansionary period? Are we in a regular normal period? All of these things will have factors on the performance of your ownership, or if your stock, if your investment, you're allowed to participate in long-term wealth creation under this umbrella. Now, moving on. Now, let's look at return. Let's understand investment returns, right? Now, investment selection should balance risk against return. Now, let's understand this. Investors are given two choices, high risk or low risk, and whichever one you pick would signal the kind of return you want. So if I pick a high risk investment, then I am looking for high return, right? And if I pick a low risk investment, oh, I don't want to lose my money, I don't want to lose my capital, then I have signed up for low returns, right? Now, historical performance again does not guarantee future results. So when people purchase stock, there are two ways to do it. You can just look at the 4 or 5 years annual statement of the company and analyze all those fantastic ratios, and it will be fine, right? But then you also need to know that whatever the company has done over the last 3, 4, 5 years does not mean it will continue to perform like that over the next 1, 2, 3 years. It has absolutely no guarantee, right? So you want to look at earnings forecasts and what are the basis of these earnings forecasts and balance them against historical analysis. Very important. So you want to make sure that you take a balance. So you want to know what the organization is doing at the time, what are the projects embarking on, what are the things that lets you know that the monies we're putting in is going to generate a greater return that will beat inflation, and that we beat also investing in fixed income, or more safer investment. Short-term prediction from past data is unreliable. A lot of things happen. Market condition changes, industry structure, industry conditions changes. Things like what's the word? The word I'm looking for is when a new entrant comes in and takes a very huge share. We used to call it disruption. Industries get disrupted, no matter how fantastic they are. And we saw that happen over the last 10, 20 years with technology driving this disruption. And then we have historical return patterns should be observed, right? Now, ownership generally will provide higher long-term return than lending. If you own over a period of 10 years, then you would have higher returns than if you lent. And if you lend over a period of 10 years, of course, it's going to be lower than if you had done ownership, which generally will be higher risk. Lending investment yield moderate returns. Cash and savings are the lowest form of, and I'm going to show this in a chart, right? Inflation reduces real gains, real investment gains, both of lending and ownership. It's just that it generally tends to be more felt and more experienced under the lending when you use lending instruments. Now, for the long-term investor, your best friend is the compounding effect of on cash, right? Now, small differences in annual returns will create what? Large, long-term wealth gaps. And what would look like a small gain annually over a period of 5 years, 10 years would really balloon out and be significant. So yes, longer investment horizons will amplify return difference. If I put $1 in and then in the next 1 year it compounds maybe at a rate of 10, right? So $100, sorry, now becomes 100 compounding by 10%, and then it goes on. The next year it's compounding by another 10%, right? So time really is the friend of the long-term investor, because time would make everything held over time to continue to compound upon itself annually. Longer investment horizon will amplify return differences. Now, investor behavior. Well, a participation in the market is required to earn growth returns. If you want growth returns, which are, of course, bigger than what you get lending investments, then you want to participate in the stock market, which is, of course, more risky. Now, staying in cash. Cash is the lowest form of holding cash, is almost zero investment. Money market fund is also on the low end, right? It would limit long-term performance. So you can't stay on the sidelines and be holding cash in the form of cash and cash equivalent or near cash and expect that you're going to be experiencing the growth. The market does not reward spectators, right? Chasing short-term win would reduce effectiveness. You look at a company that delivered 100% and you think it's going to deliver another 100 or 200 over the next 1 year, and then you put in your money, and then you put in your money and say, okay, we will not even call you an investor, we'll call you speculator, right? Short-term wins in the market will reduce, chasing the short term would reduce your effectiveness in the market. Consistent market exposure, like I said, stay in the market long enough, right? It matters more than outperforming averages, which would pretty much be speculation and trading. Now let's look at this. An initial 10,000 in all cases, that in all of these cases, we're looking at investing 10,000 in all cases. And the table will illustrate how even small differences in annual return can dramatically increase and create different outcomes over long periods due to compound growth. Now, if your rate of return, of course, we have savings accounts, 4%, 5% for a bond, and then 9% for stocks and real estate. You can see it's greater promise of return or greater expected return than the more savings oriented. And these are ownership oriented. Now we have $10,000. At these rates, savings account would have grown to 26 after 25 years. Bonds would have grown to 33 after 25 years. On the other hand, real estate and stock would have made the money over on investment. 10,000 after 25 years will become a whopping 86,000 US dollars. And if we expand that to 40 years, our 10,000 US dollars would have grown about 4 times, right? About 4 times, going up almost 5 times, right? Which is 48%, 48,000, sorry. bonds held over 40 years would have increased to 70,000. But you cannot even match stocks growing at 9%. It will be 314,094. So it's very important. But then again, like I said, these investment rate of returns, this is more guaranteed, right? These two are significantly more guaranteed. This is not guaranteed, but if you do your homework very well and you pick good companies and then you stay long enough, then you're going to get your returns. It's also very important to understand your investment risk. It must be evaluated in real terms. And when we say real term, we consider inflation and after-tax returns. Low volatility does not always mean low long-term risk. If an investment has very low volatility, in other words, it doesn't spike up, it doesn't spike down that much, doesn't mean that your long-term risk is going to be also low. And long-term goals require protection against inflation erosion, right? So when you want to do for 10, 20, 25 years, again, right? That's why the stock market is your friend, because over time, money will lose value. You want to make sure that your assets is appreciating, your financial asset is appreciating and beating inflation, right? Now, when it comes to assessing risk, you want to understand the purpose of the investment. Again, like I said, what am I investing for? Retirement or the purchase of a house? Retirement is long term, the purchase of the house is short term, right? Okay. Determine the investment time horizon and then evaluate historical volatility. You want to make sure that you understand the volatility of this investment instrument or asset class and then match volatility to your comfort level and timeline. Make sure that your investment goals will align with the investment vehicles that you choose. Now, ownership comes with short-term price fluctuation. Like I said, in the next 1 week, in the next 1 month, in the next 1 year, you're going to see short-term fluctuation. But organizations grow and economies generally grow over the long term, right? So even though market declines will happen periodically, there will be cycles, there will be sentiments, large drawdowns happens over longer cycle. The real estate, even stock, exhibits this same level of what? Volatility, cyclical volatility, and higher returns will require tolerance. When these volatilities are happen, you don't back out, you don't pull out your money, you don't get scared, right? In a long-term investment, your emotions can be an investor's worst enemy, right? Now, for the best results in portfolio appreciation, you want to make sure that you don't concentrate all your funds into volatile assets, right? You put your funds everywhere. Yeah, it's going to grow. It's going to grow. It may not grow. And generally, it won't even yield the best returns. Oh, it won't generally have the probability of the best returns if all your stocks are held in very volatile instruments. Make sure that you understand the difference between short-term and long-term. Keep your short-term emergency funds out of volatile instruments because, like I said, the money you want to use to purchase a house annually is likely to, it can lose as much as 50%, not purchase, rent a house. So I've accumulated, I'm supposed to accumulate like 1.5 million in Nigerian terms, Nigerian naira, to be able to rent my house, to be able to pay my rent. And then I put it in the stock exchange. It says it's going to appreciate. Nah, it might not appreciate. Shorter horizons. For shorter horizons, make sure that you use the lending type of instrument over the short term, right? Lower risk. Longer horizons, then you know you can remove your eyes and allow it grow as it should. Now let's look at this. Years of investment held. If you have 1 year, there's the likelihood that stock will meet. Look at if you chance that stocks will beat bonds, right? If you hold investments for 1 year, the likelihood that stocks will beat bonds is only 60%. So the chance that bonds, even with its modest return, might outperform stock 40%. If you hold an investment for 5 years, the likelihood of stocks beating bonds will rise up to 70%. There's an 80% chance that your stocks will beat bonds if you held as long as 80%. As in 91% if you hold as long as 20% in 30% for 20 years, sorry. In 30 years, the probability is almost 99%. Even 99% that stock would certainly beat bonds over a 30-year time frame. Now, let's look at this. Now, this is for stock market investors, people who decided to take their risk on the stock exchange. My advice for people who wants to play the stock exchange, and again, playing the stock exchange does not mean you should not hold safer kinds of instruments, right, in lower risk areas. There are lots of asset classes that you can invest in, right? And you should use that to balance out using very good diversification process. If you can, you should be able to calculate your risk exposure properly using the risk and be able to build a good risk return curve. The work has already been done. Diversification is not just putting your money out in many various places. It can be calculated. The risk your capital is exposed to can be calculated. So that said, let's look at for those who want to do stock market investing. Well, in days, sentiments matter more than earnings. So sentiments move the markets if you are holding in the first few days of investment. So when people say that, oh, the stock market is a very sentimental, very sentimental. Oh, when I put my money, then the traders are scared, and then they pull out of the, and then I lose my fund. Oh, well, they're correct. In the short run, sentiments run the stock exchange, right? As we begin to move up the time frame, you can see that the role played by sentiment decrease, and the role played by earnings in the performance of your capital will significantly increase. So my advice for people who want to play the stock exchange is very simple. Do your research very well. Understand what the organization does, understand the environment where it plays, its industry, its competition, the policies driving it, and then the company itself, the management, and how well they have been performing. What are their projects and what are the forecasts on this? And then when you have seen that is a company that is right for you, you place your bets, and hopefully over time it will grow. Now, higher bond yields will compensate for higher risk. Again, the two major risks with lending is defaults and inflation. Those are the two major risks. If you choose a lending instrument, then there's a chance that whoever you're lending to will default. there is also a chance that inflation will beat or will eat into it. Lower credit quality would increase your default risk and required return, right? So that goes. So there are rating agencies that can tell the quality of the creditor, and if the creditor has have Moody, and I think Standard and Poor's, right? And if the rating is really, really poor, then there's a very high chance that you have an increased possibility of risk. And then of course it will affect your required return because for taking on that level of risk, you would be expected to have more returns, right? But it doesn't quite work out that way. So longer maturity will increase interest rate risk and required return risk. So you hold out for a longer time, right? Then you'd be looking at the risk of interest rates eroding the value of your investment and your required return, right? So you want to focus on risks that are controllable. You cannot predict stock market risk, right? But generally, like we said, it would even out and become net positive over time. Growth investments require that you accept volatility. Use long-term funds for higher return assets. Make sure you diversify. That will reduce your risk and don't concentrate in very few instruments. I think we've said that, and that brings us to the end of this section of the class. And as we go on, we're going to talk about the investment instruments one by one, step by step, and help you to be able to understand how to use them, how to invest in them, and how to have value over time. So that brings us to the end. Thank you very much. Thank you very much. And I'll see you in the next video. Bye for now.